We've got our first opinion coming through, and it's a big one. We have Nathan Sheets, Global Chief Economist at Citi, who's with us. Mr. Sheets, great to have you with us here. Good morning. Appreciate your time here. All eyes on, of course, the election outcome here in India in the first week of June. If you've had any interactions with investors with regards to India lately, would be great to hear that feedback. What's the view, really, which is forming around this one?
I'd say two key observations. First, on the election, I think amongst the investors that I speak with is pretty much a broad view and a broad conclusion that Modi will be successful in this election. If somehow that were to fall short, I think that would be, from the global investors' standpoint, would be a very big surprise and an adverse shock. So that is something we're watching closely. But more broadly, I think we're seeing global investor sentiment toward India, frankly, about as positive as I can recall over the course of my career. And I think that a lot of that is a reflection of anxieties about the geopolitical situation and the relationship between the United States and China. And I think there are a lot of money managers and a lot of corporates that are saying, well, if we're not going to be as intensive with China, where else can we go? And I think that particularly in the investment space, that India has been a winner in that rebalancing away from China.
Nathan, hi, good morning, and thanks for joining. And I want to come back to that point you made earlier about how global watchers are very keenly looking at the BJP-led NDA's dominance in the elections this time around. But if that does not play out, would that reduce your investments or interest in a market like India, if there is some policy instability?
I think it would. And one of the things about the Modi-led government is that investors are familiar with his policies and comfortable with his policies. And it would be a period of evaluation as to what another government would look like and what its emphasis would be. So I think a major barrier is just kind of the familiarity with the Modi government and where we've been. And if things were to pivot in a different direction, as with any country, there would be a period of evaluation by investors. And then ultimately that new government would be judged by what does it stand for, what's it seeking to do, what are its policies.
All right. Hi, Nathan. Good morning and good to see you in. So we'll wait for the political outcome out here and then we get a better sense in terms of direction. But what about the Chinese economy? How are you reading that? In terms of a market performance, that's a bombed out market. And that's why it's relatively outperforming us. But they've been making some moves. The central bank out there, we hear various sound bites as well coming out of them. How do you view the Chinese economy and how does it compare, at current levels in comparison to what India is doing? Because India has been the rank outperformer.
My sense is that the Chinese economy, say over the next 12 to 18 months, is likely to do okay. They've announced a growth target of around 5%, and I think that that's a plausible outcome for China during the coming years, somewhat softer than what we're expecting for Indian growth in 2024. But the key point with China is that when I look out 3, 4, 5 years, I see a lot of challenges for President Xi and the Chinese authorities, from debt and leverage in the economy, aging demographics, big questions of where future growth is going to come from. They're trying to rev up their export engine. But then the question is, well, is the U.S., is Europe going to open up its markets to China? And then finally, as I've alluded to, I think the geopolitical realities and the tensions between the United States and China more broadly are a major headwind to the Chinese economy going forward. So looking at a 10-year trajectory and a 10-year horizon, I think I like the outlook for India a lot better than I like the outlook for China.
Nathan, just one more point since we're talking about the globe. You know, when we chatted the last time, you're expecting rate cuts in the second half of the year, and that's most likely to be the case, if at all any. How many are you factoring in now?
Well, I have to confess that as the year has progressed, the number of rate cuts that I've expected for this year is being reduced. That there's just no other way to put it, that for the U.S., Q1 inflation was just a dreadful upside surprise. It was a veritable nightmare in the first quarter on the inflation front for Jay Powell and his colleagues at the Fed. And I think we've moved from a world where 3 cuts during the second half of the year seem plausible to now where the debate is probably more 1 to 2 cuts. I'm still hopeful that maybe we can get the 2 instead of the 1. But we've got to see better inflation performance than we saw during the first quarter. There's work to do, and I think the Fed's going to have to keep rates where they are for a while longer.
Right, Nathan. Will the global risk appetite for equities remain positive through the year for equities? I mean, in major markets, and of course, US is the driver. Because, rate cuts, it'll happen sometime, right? So that promise is there. When is the question? But that promise also can keep investors excited and sort of looking forward to it. And hopefully the economy will not weaken too much. So it's like weaken a little bit, allow them to cut rates. It's the ideal situation. And that keeps everyone happy. Do you think that's what we're going to see?
I think I'd be cautiously optimistic about risk appetite through the remainder of this year. My sense is that we're continuing to see resilience in the global economy, that the global consumer, broadly speaking, continues to perform well. Spending is continuing in a number of economies at a reasonable pace. And then when you couple that with ongoing rate cuts in a variety of places. We've talked a little bit about the United States. The Swedish Riksbank started cutting this week. Our expectation is that the ECB and the Bank of England will start cutting mid-year. So the combination of a resilient economy and some rate cuts from a variety of central banks, both EM and DM economies, is likely to be enough to keep risk appetite pretty solid through the remainder of this year, I would expect.
Okay, Nathan, thanks a lot for joining in. And what stayed with me is your view that from a 10-year horizon, you prefer a market like India over China, considering that China is dealing with aging demographics. And of course, in India, in the very near term, some political volatility cannot be ruled out. Always a pleasure talking to you, Nathan. Hopefully, we'll get to speak to you again very soon. Let's take a quick commercial break on that note. We have many more stocks to discuss on the other side of the break, so don't go anywhere.